Booyah! Let's talk tariffs. Tariffs are a hot topic in the world of international trade, and they can have a huge impact on the economy. But what exactly are they, and how do they work? Let's dive in and find out. They're like taxes on imports, making foreign goods more expensive. When a country imposes a tariff, it adds a fee to goods coming in from other countries. This fee makes those goods more costly for consumers and businesses in the importing country. Governments use them to protect domestic industries or punish other countries. By making imported goods more expensive, tariffs can help local businesses compete with foreign companies. Sometimes they're also used as a political tool to pressure other nations. Think of it like this: China's selling cheap TVs, hurting our TV makers. When foreign companies can produce goods at a lower cost, they can sell them for less, which can hurt domestic producers who can't compete with those low prices. We slap a tariff on those TVs, making them pricier. This added cost can level the playing field for domestic manufacturers, giving them a better chance to sell their products. Now, American-made TVs are more competitive. With the higher price of imported TVs, consumers might be more inclined to buy domestically produced ones, boosting local businesses and the economy. But hold on, tariffs are a double-edged sword. While they can help domestic industries, they can also have some negative effects. They can hurt consumers by raising prices. When tariffs are added to imported goods, the extra cost is often passed on to consumers, making everyday items more expensive. That new TV? Now it costs you an arm and a leg. This can lead to decreased consumer spending, which can slow down the economy. Plus, they can spark trade wars, with other countries retaliating with their own tariffs. When one country imposes tariffs, others might respond with their own, leading to a cycle of retaliation that can harm global trade. It's a messy business, folks. Trade wars can create uncertainty in the market, affecting businesses and investors worldwide. Understanding tariffs is crucial for investors. Knowing how tariffs can impact different industries and the overall economy can help investors make informed decisions. Why? Because they can shake up the stock market like a bull in a china shop. Tariffs can lead to market volatility, with stock prices rising and falling based on trade news and policies. Stay with me, and I'll break it down so even your dog can understand. We'll explore the ins and outs of tariffs, their effects on the economy, and what they mean for you as a consumer and an investor. So let's get started. Tariffs create winners and losers in the stock market. Companies benefiting from protections see their stocks soar. Take steel. Trump's tariffs on foreign steel? Boom! Domestic steel stocks went through the roof. On the flip side, companies relying on imported goods or selling heavily overseas, they feel the pain. Remember the US-China trade war? Apple, heavily reliant on Chinese manufacturing, saw its stock take a hit. Investing during tariff battles is like riding a roller coaster blindfolded. You never know which way it'll go, but fear not, knowledge is power. Remember when Trump imposed tariffs on Chinese solar panels? First Solar, a US manufacturer, saw its stock jump nearly 50%. Why? Less competition from those cheaper Chinese panels. But there's a flip side. Whirlpool, the appliance giant, saw its stock tumble when tariffs on steel and aluminum were imposed. Those materials are crucial for washing machines and refrigerators, driving up their production costs. Ouch! These examples show how tariffs can create both opportunities and pitfalls for investors. You gotta be nimble, you gotta be quick, you gotta be informed to navigate this market. Different industries react to tariffs in different ways. Companies relying heavily on imports get squeezed. Think automakers using foreign parts or retailers stocking up on overseas goods. Their costs go up, potentially hurting profits. But domestic industries shielded from foreign competition, they might thrive. Steel, aluminum, even some manufacturing sectors can benefit. Their products become more competitive, potentially boosting sales and stock prices. The key takeaway? Don't put all your eggs in one basket. Diversify your portfolio to weather the tariff storm. Section 5. The Consumer Connection: Tariffs and Your Wallet. Tariffs aren't just some abstract economic concept. They hit you right where it hurts, your wallet. Remember those washing machines Whirlpool makes? Tariffs on steel and aluminum meant higher prices for consumers. And those cheaper Chinese goods you love? Tariffs can make them disappear from shelves or become more expensive. That's less money in your pocket and potentially less spending overall, which can hurt the economy and the stock market. Remember, a healthy economy means a healthy stock market. Tariffs can disrupt that balance, making it tougher for businesses to grow and investors to prosper. Section 6. Global ripples, tariffs, and international markets. Tariffs don't just impact the country imposing them. They have a cascading effect that can influence economies far beyond their borders. When a country decides to impose tariffs, it often leads to a chain reaction. Other countries may retaliate with their own tariffs, leading to a tit-for-tat escalation. They create ripples across the globe. These ripples can affect everything from the price of goods to the availability of raw materials. For instance, a tariff on steel can increase the cost of manufacturing cars, which in turn can raise car prices for consumers. When countries engage in trade wars, everyone feels the burn. Trade wars can lead to increased prices for consumers, reduced export opportunities for businesses, and strained international relations. The economic downturns that follow can be severe, affecting employment rates and economic growth. Businesses become uncertain, investment slows down, and global stock markets can become volatile. The uncertainty makes it difficult for companies to plan for the future, leading to reduced investments in new projects and innovations. Remember the US-China trade war? It was a prime example of how tariffs can escalate into a full-blown trade conflict. The tariffs imposed by both countries led to increased costs for businesses and consumers alike. It created uncertainty and volatility in markets worldwide. Investors were left scrambling to adjust their portfolios, and the stock markets experienced significant fluctuations. Companies relying on global supply chains faced disruptions and had to adjust their strategies, often at a cost. These disruptions can lead to delays in production, increased costs, and even shortages of essential goods. The interconnected nature of the global economy means tariffs in one place can have far-reaching consequences. A tariff imposed in one country can affect businesses and consumers in another, highlighting the importance of international cooperation and trade agreements. Investors need to stay informed about global trade developments to make smart decisions. Understanding the complexities of international trade and the impact of tariffs can help investors navigate the volatile market landscape and make more informed investment choices. Section 7. Long-term outlook. The uncertain future of tariffs and stocks. Predicting the long-term impact of tariffs on the stock market is like predicting the weather in March. Unpredictable. It all depends on how long they last, how other countries react, and how companies adapt. One thing's for sure, uncertainty is bad for business. If companies are unsure about future trade policies, they're less likely to invest and grow. This can lead to slower economic growth and potentially hurt stock market performance in the long run. Investors need to stay vigilant, monitor policy changes, and adjust their portfolios accordingly. Don't panic, but be prepared. Section 8. Investment strategies in a tariff-heavy world. So how do you navigate the stock market in a tariff-heavy world? First, don't panic. Market fluctuations are normal, and reacting impulsively can often lead to poor decisions. Second, diversify your portfolio. Diversification is key to managing risk and ensuring that your investments are not overly reliant on any single sector or market. Don't put all your eggs in one basket, especially in industries heavily affected by tariffs. By spreading your investments across different sectors, you can mitigate the impact of tariffs on any one industry. This means looking beyond traditional sectors and considering emerging markets and industries that may be less affected by trade policies. Look for companies that can benefit from tariffs, like domestic manufacturers. These companies may see increased demand as tariffs make imported goods more expensive. Additionally, companies that have a strong local supply chain may be better positioned to weather the impact of tariffs. Consider companies with strong domestic sales, reducing their exposure to trade tensions. Businesses that rely less on international markets and more on local consumers can be more resilient in a tariff-heavy environment. This includes sectors like retail, healthcare, and utilities, which often have a strong domestic focus. And remember, a diversified portfolio is your best defense against market volatility. By including a mix of asset classes such as stocks, bonds, and real estate, you can create a more stable investment strategy that can withstand market ups and downs. Investing in a tariff-heavy world requires careful consideration and a long-term perspective. It's important to stay focused on your long-term goals and not get swayed by short-term market movements. Patience and discipline are crucial in navigating these challenging times. Don't make rash decisions based on short-term market fluctuations. Instead, take the time to research and understand the underlying factors driving market changes. This will help you make more informed investment decisions. Stay informed, stay diversified, and stay calm. By keeping a level head and sticking to your investment strategy, you can navigate the complexities of a tariff-heavy world and achieve your financial goals. Section 9. Conclusion. Navigating the tariff landscape. Tariffs are a complex issue with far-reaching consequences for the stock market. They can create winners and losers, spark volatility, and impact industries in different ways. Understanding how tariffs work and their potential impact is crucial for investors. Remember, knowledge is power. Stay informed about trade policies, diversify your portfolio, and don't be afraid to seek advice from financial professionals. By staying vigilant and adaptable, you can navigate the tariff landscape and come out ahead. Now go out there and make some money.